Chapter 8, Internal Control and Cash. Internal control, when structured properly, allows a company to operate efficiently and effectively without the burden of improper or inaccurate information. The objectives of internal control establish a goal. By addressing the key components of an internal control system, the goals of internal control are more easily achieved. There are many ways that control can be maintained. Control, according to the Committee of Sponsoring Organizations, inevitably involves people. Therefore, a good control system must have, at its core, competent and reliable personnel. In order to track control breakdowns, responsibilities must be assigned throughout the organization. In addition, some of those duties must be separated in a way that requires more than one person to carry a transaction to its finality. Other controls include the use of audits to determine the degree to which the control system is working. This triad should just test your knowledge of certain vocabulary words from internal control systems. The Sarbanes-Oxley Act, passed in 2002, is a comprehensive set of rules that govern the relationship of management and the external audit firm. Among its components is a requirement that companies review their internal control structure. Management is required to take responsibility for both the effectiveness of the internal control system and the accuracy and completeness of their financial reports. Failure to fulfill that responsibility can lead to both fines and also prison time. Internal control is defined as an organizational plan and all the related measures adopted by an entity to safeguard assets, encourage employees to follow company policies, promote operational efficiency, and ensure accurate and reliable accounting records. Encryption involves the rearranging of plain text messages by a mathematical process. Given that all electronic communication, once launched into a network, is deemed to be permanent, it is recommended that all network communication, including email and all files that reside on the network, be encrypted in a manner that prevents it being read by an unintended third party. In most medium-sized and large organizations, responsibilities must be divided among employees so that it takes more than one person to finalize a transaction. For example, the person who approves invoices for payment should not be the same person who writes or signs the checks. In small companies, separation of duties can be difficult to accomplish. In such cases, other compensating controls should be in place. The internal audit function in any organization has, as its primary mission, ensuring that the company's employees are complying with company policies. In order to accomplish this task, the internal audit function should occupy an organizational status of internal independence, reporting directly to the company president and/or the board of directors. The control cycle for cash receipts involves several different controls. The controls start in the mailroom, where a mailroom employee opens the mail. Most companies ask for checks instead of cash. The employee records the checks received and forwards them to the treasurer or treasury for deposit in the bank. At the same time, a remittance advice, which is a listing of the checks and amounts received, is sent to the accounting department. The treasurer deposits the cash and checks in the bank with a deposit slip. A copy of the deposit slip is validated by the bank and then forwarded to the controller. The accounting department records the amounts from the remittance advice in the books, then forwards a copy to the controller. The controller now has a copy of the deposit amount showing the amount that was deposited in the bank and a copy of the remittance advice that shows how much was recorded in the books. These two amounts must match. For this, try it. See if you can fill in the blanks. Cash payments also have controls that support each other and ensure proper disbursement of cash. First, a purchase order is prepared and sent to the vendor. Second, the inventory is sent by the vendor to the company. At the same time, a copy of the invoice is sent to the company. When the inventory is received, it is counted and compared to the original purchase order to ensure that what was received matches what was originally ordered. A copy of the receiving report is then sent to the accounting department where it is matched against the invoice. If the amounts match, the invoice is authorized for payment and a check is then sent to the vendor. Each of the documents in the process are prepared in multiple copies. For example, the purchase order has at least 3 copies. One stays in the originating department, 1 copy goes to the vendor, the 3rd copy is sent to the receiving department to be matched against the packing list that comes with the delivered inventory. Only when the system is able to match all 3 documents, purchase order, receiving report, and invoice, is the invoice authorized for payment. When the invoice is authorized for payment, a voucher is prepared that goes to the cashier. The cashier prepares the check for payment based on the voucher. However, the cashier is not allowed to send the checks until they are signed by the appropriate officers in the company. Let's try another fill-in-the-blank triad. Petty cash is a common asset in many offices. Essentially, it is a small amount of cash that is maintained physically on site for everyday expenses or small emergencies. In a single office operation, the issue of petty cash may not be material. However, in a company that has tens of thousands of employees, organized into hundreds or thousands of separate offices or departments, each having its own petty cash, the amount of physical cash company-wide can become significant. The immense size of the cash amounts that comprise all of the separate petty cash amounts spread throughout the company requires effective controls be put in place. To set up the petty cash fund, a journal entry is prepared that shows a credit to cash and a debit to the petty cash fund. A check is written and cashed at the bank. The cash is then placed in the custody of a responsible employee who must administer the fund. As the petty cash is used, it must be replaced either with petty cash disbursement tickets or with the actual receipts. At any given time, the amount of actual cash in the petty cash fund and the receipts and tickets in the fund should total to the original authorized amount of the fund. In some circumstances, there are small amounts that are not accounted for. At the end of the period, the petty cash fund is replenished. A journal entry is prepared that records each of the receipts and tickets in the fund. Any unexplained cash discrepancies are recorded in an account called cash over and short. A check is written for the expended amounts and the cash is put back into the fund, returning it to its original balance. Record the following transactions for this triad related to Green Golf Equipment's petty cash fund. On May 1st, the fund is set up with a debit to petty cash and a credit to cash. On May 31st, the receipts are recorded as expenses and a check is written to replenish the fund to its original balance. Most of the company's cash is kept in bank accounts. The bank statements can be used as additional controls to keep proper control over the company's most liquid and vulnerable asset, which of course is cash. When a check is prepared, it will have a remittance advice, sometimes called a check voucher, that shows the pertinent information about the check. Often the bank balance on a given date and the balance on the books on that same date differ. There are often very good explanations for the difference, such as checks that the company has written and deducted from its books, but which have not cleared the bank. To explain the difference between the two unequal balances, a bank reconciliation is prepared. Some activities have been conducted by the business, but there is a time delay between the transaction and when the bank learns the information. These activities include deposits in transit and outstanding checks. There are also activities that happen at the bank that the business does not learn about until they receive the periodic bank statement. These activities include amounts collected by the bank, electronic funds transfers, bank service charges, interest that is earned by the company or that is owed by the company, and non-sufficient fund checks. A normal reconciliation includes two parts. Part A starts with the bank balance and adjusts the balance for deposits in transit and for outstanding checks. Deposits in transit are added to the bank balance. Outstanding checks are deducted from the bank balance. In some cases, the bank statement indicates errors made by the bank. Those errors must be added to or subtracted from the bank balance in order to arrive at the adjusted bank balance. Part B of the bank reconciliation starts with the book balance. The bank statement should be analyzed. Any amounts that the bank added to the account during the period should be added to the book balance. Any amounts that are subtracted by the bank should be subtracted from the book balance. Again, any errors in the books must be included with Part B of the reconciliation. Examine the information and then prepare the appropriate bank reconciliation. Part A, Bank, starts with the bank balance of $12,720 and adds deposits in transit of $9,000, then subtracts the outstanding check of $2,000. This ends with an adjusted balance of $19,720. Part B, Book, starts with the book balance of $20,850. The bank statements show that the bank collected $100 from a customer and that the bank added interest to our account in the amount of $30. These amounts are added to the book balance. The bank statement also shows a service charge of $20 and an ETF payment for a water bill of $40. It also includes a non-sufficient funds check of $1,200. These amounts are subtracted from the book balance. The adjusted balance is $19,720. More importantly, the amounts from Part A and Part B are equal, indicating that the reconciliation was properly prepared. Finally, a journal entry is prepared for all the adjusting items on Part B of the reconciliation. Anything added to the reconciliation will be credited. Anything subtracted from the reconciliation will be debited. The difference will either be a debit or a credit to cash to make the journal entry balance. Let's take a look at another try-it, which involves matching. Match each action with the appropriate reconciliation item.